Rates in the fives. People have been talking about that for a long time. General consensus is when the rates start getting into the fives, a lot of buyers are going to come out of the woodworks because that's really what we're seeing is not that there's a lot of inventory, it's that there's a lack of buyers. Now, there was news recently that the government is looking to buy a recommended $200 billion in mortgage backed securities. That's something that they did back in the COVID times that helped artificially deflate rates. There's a lot of debate over what's the long term implications of that. But here's one thing I want you to know that doesn't mean rates are driving back into the threes and fours. That's not what it's going to do, but they're trying to push them back, a little bit lower to make affordability increase. Now, what you can see is the market already reacted to that. We finished off the year about six and a quarter. Now we're sitting about 6.16. So it is getting closer. But I'm here to tell you if you want something in the fives, you don't have to wait for that. So let's take a look here. These are the VA mortgage rates right now. Now it's averaging about 5.77. So we're not talking about low fives, but they are in the fives. And these are 0 point rates that we're looking at. FHA, similar, a little higher than VA, but again, you're going to be in that high fives kind of area. Now, if you're somebody who says, I don't really want to go with the VA because you do have to pay mortgage insurance at least for the first 11 years of the loan, regardless how much you're putting down, and I'm not VA eligible, there are other options. You can look at ARMs. If you think rates going to go down in the next couple of years, go with a 5-year ARM. It's in the mid fives today. You can go with temporary buy downs, 1-0 buy downs, 2-1 buy downs, where rates start 1 or 2% below the market, but then eventually move up a little higher. That gives you the leverage to be able to get in there today. And with a limited inventory or limited buyers that are there working on inventory, you can actually negotiate that the seller is picking up those costs. You can also do the same thing with permanent buy downs. You saw the rate was at 6.16. If you're paying points, that means you're likely getting a rate in the high fives. Now, again, limited buyer pool means increased opportunity for you to be able to leverage negotiations with the seller, have a better chance of making that money. Now, if you look at what we're looking at for 2026, the spread here between Fannie Mae at 5.9 and the Mortgage Bankers Association at 6.4 averages that people think we're going to wind up at 6.2, which is where we are today. So again, my advice, and I've said this before, is if you're a buyer in the market, now's probably the time to strike because rates aren't getting aggressively lower, at least based on current circumstances and everything that we see. But they're not looking to get aggressively lower. But I think buyers are going to start becoming privy to all the examples I gave on the slides before and realize that 5% rate that they've been holding out on is something that's available and they can go ahead and get that in the market. When they do that, it's going to increase buyers coming into the market, which means increased competition, which means prices that are driving up. So, in a world that you're likely not going to save a ton by holding out for the next 6 or 12 months on the rate front, and you might see a difference as far as competitiveness and what that does to price, my advice is strike in the market. There's a lot of opportunities to get that 5% today. There's a lot of opportunities to put you in a really good spot from both a price and negotiating standpoint. Hope you have a great Wednesday. Take care, everyone.